People who work in a business use money and credit to run it. It is a way to get money for business activities, buy things, or invest. In any business, money is very important, or we can say that money is the foundation of a business. Finance is needed to buy things like assets, goods, raw materials, and everything else that goes on in the economy. Businesses, consumers, and investors all need money to reach their goals. Finance institutions like banks give businesses, consumers, and investors money to run their businesses. The use of financing is too important for any economic system because it allows businesses to buy things that they can't afford right away. Hi and welcome to Finance Advisor. In this video today, we will educate you about how business finance works and how company and other institutions benefit from it. This is one of the secret videos on the internet that will get you grounded in everything you need to know about financing a business or organization to remain in operation. Stay till the end of this video because you might not want to miss this insight today. The word debt is used a lot, and most people know that debt is called a loan. It is a way to get money because they have car loans or mortgages, so they get money. Debt is also a common way to start a business. Debt financing must be paid back. If you need a small amount of money for a specific thing, debt is easier to get. This is mostly because you can use the things as collateral. While it is important to pay back even in bad times, the company still owns and runs the business. In finance, many of the basic ideas come from microeconomic and macroeconomic theories. The time value of money is one of the most important theories. It says that $1 today is worth more than $1 in the future. It includes banking, leverage or debt, credit, the money and investments, and the creation and oversight of the systems that deal with these things. Microeconomic and macroeconomic theories are used to explain basic financial concepts, and these theories are used to explain how money works. Personal finance, corporate finance, and public finance are three main types of finance. Finance is about how to manage money and how to get money. Finance is a term used on the board to describe things like banking, leverage or debt, credit, capital markets, money, and investments. Business finance tells you about how the business gets its money and credit, and how it is run. When you look at financial statements, you can also learn how to better manage your money and funds to make your business more profitable. In the aspect of profit, loss, cash flow statement, and balance sheet. So, in a simplified term, you can refer to business finance as funds offered to any business by a financial institute for the purpose of running the business. In one way or the other, it can also be referred to as business loans, and they are grouped in two types. Talk about short-term and long-term finance. Let's take a look at short-term finance. Getting money for the business for less than 1 year is called short-term finance, also called working capital financing. This is how you get money to pay your bills. Short-term financing includes trade credit, working capital loans, invoice discounting, factoring, and a business line of credit. This type of financing is called short-term. Loans that last for a while are more safe than long-term investments, but short-term loans are more risky than medium-term loans. When it comes to risk and reward, it often looks for a good balance between the two. While long-term financing is money that is given for more than 10 years at a time, finance that lasts for a long time is also called fixed capital finance. All long-term financing is made up of equity and preference capital, as well as debts, long-term loans, and retained earnings. Definitely, money is one of the most important parts of running a business. With a lot of money, a lot of cash flow, and a lot of transactions, it's important to keep an eye on and manage them all. It helps the company decide what to spend, where to spend, and when to spend. Financial management is more specific. When a financial institute funds a business, it helps the business to make money. You need money to start a business. It is clear that in order to start your own business, you will need to put money into it. As you move up the timeline, you'll need to keep track of your money as you buy materials, hire professionals, market, and test. Plan and manage operations. Businesses make a lot of money every day. All the money must be used again to pay bills, give money to others, invest in multiple projects, and keep an eye on all of them. Keeping track on how much money, which comes in and goes out of your business, is important. It's hard to spend money wisely and effectively. Keep an eye on cash flow. Having too much funds can be as bad as having too few. To keep an organization running smoothly, it is important to keep an eye on their cash flow. As long as you have money and aren't using it the way you should, that means you're wasting things. For a company that has extra money, they should put it to good use and invest in big projects that will help them grow their business. Plan for funding. The obvious thing to do is set aside money and use it to figure out how much money you spend each month. However, it's not smart to spend any or all of your money without first planning how you'll spend it. You need to keep track of how much you spend, how often. Then you need to decide how much to spend. At times, it is important to cut down on extra costs and cut down on costs. List long-term goals. There are a lot of things that organizations do to grow and make their business bigger and bigger. There should be a lot of big goals that the organization wants to achieve in the next 5 or 10 years. Helps an organization reach its goals without fail. Take into account that you want to spread your organization to 3 new cities. The money runs out while you are actually making the plan happen. This is called running out of money. This wouldn't have happened if you took care of your organization's finances first and then did what you had to do. Before you start working on your goal, you should think about how much money the organization has available. This way, you won't have to deal with any problems in the future. Sustain the economic downturn. If you look at the growth graph of a company, you will never find one that rises straight or doesn't have any curves. A business cycle is a mix of highs and lows, which could be caused by many different things. It doesn't matter if a business is in a recession, if it's growing, or if it doesn't work at all. With enough money and good financial management, it's easier for the organization to go down the business cycle. Every time they face a problem and the consequences, they don't have to be afraid that they will shut down. Failure-proof financial management plans help the organization stay strong even when the economy is bad. It is obvious that all businesses need both money and management. Organizational leaders must be able to see through all their company's financial activities, from collecting funds to allocating and spending them. They also need to plan for how to use the resources their company has available in the most efficient way possible. If you love the effort we put in here to create a great content like this, kindly join us by clicking the subscribe button and activate the notification bell to be the first that will view our next interesting videos. Until next time, please write us your thoughts about today's video in the comment section below.